Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mish Schneider, Director of Trading Education at MarketGauge, to discuss the potential impact of the Russia-Ukraine conflict on the Fed's policy decisions and why small caps could be key in this market. Mish, it's great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. Great to see you.
Where do we even start here? I think the best thing to do is take a look at the charts because, we thought December and the beginning of January were quite volatile, but February really ushered in some geopolitical news to kind of change the landscape.
Well, what's so interesting is that the charts, I find more and more and more, and I've been doing this for an awfully long time, but the longer I do it, the more confirmation I get that if you shut out the noise as much as possible and just watch the technicals, you get everything you need to know. In fact, I saw somebody tweet recently that a good technician is probably much better at calling the macro than any macro expert. And I really believe that. And so that's why we're so fortunate that we have our economic modern family, because the small caps, as you just mentioned, has been key to everything. So back in November, it was already starting to roll over to the downside before the S&P, before the Qs, and retail space also was rolling over to the downside. So a lot of the things we needed to see the economy reversing to heat up was actually telling us the opposite. And now here we are with the Russian-Ukraine situation that put the big smack down. And what happened? The first index to firm up, hold triple support at around that 188 to 190 was the small caps, once again, IWM. And so the rally that happened yesterday, followed by the follow through we're getting today, is not a great surprise, because basically what you and I talked about last time was this range bound market in a stagflation environment, and that's playing out to the T.
Right. And it's really interesting because we saw swings yesterday was a great example. You can get anywhere from 2, 3, 4% swings on any given index. And the technical work, whether it's short term or longer term, still seems to work here. So when we talk about gold, I mean, obviously all commodities have been a factor here when we think about oil, natural gas, and how that relates to inflation. But gold, with the inflation story and with geopolitics, really has been the place to be.
Well, yes, and yet it's still very much in a situation where you got to sell the rallies and buy the weakness. And that's pretty much the opposite of what most traders are trained to do, which is follow the momentum up and get out when things are weak. But gold and silver, even oil, have been kind of the opposite of that. And I think it's because people very quickly forget that gold and silver, even though they've still been underperforming relative, let's say, what the Dow has been, and certainly if we look back in time, it's well underperforming, they still have a lot of catch up to do here. And I think it continues to keep people on their toes. And so gold went up to 183 in terms of the GLD yesterday on the open, and then proceeded to sell off like $70. I mean, it's also very volatile, but I think that gives you a unique buy opportunity. And I'm still looking at gold and silver to go forward, because I think essentially what we can really see between the lines with what the Fed is saying is, as hawkish as they were going to be initially, they've stepped back. In fact, Powell came out with some comments on that today, because they're worried. They're still worried about Omicron and the fact that the economy hasn't come back to the way they wanted. And of course, now the Russia-Ukraine becomes the great scapegoat for why inflation is now peaked up even greater, but yet is probably still transitory, because that eventually will go away. And that gives the Fed permission to be more dovish. And I think that's why one of the reasons why the market's rallying so much.
And we saw that in the Nasdaq 100. Of course, that was the index that led the way. I mean, quite the reversal from, being at the bottom in the futures, and then the way it closed yesterday. Some of those stocks up 4 or 5%, and we're talking the mega cap stocks like Amazon, like Apple.
Right. I mean, for me, who's been a commodities trader, that's where I started. These equities are trading like commodities, which is amazing to see that type of range, that type of volume, and that type of volatility. I think it really behooves people, though, to keep a focus on not get too crazy looking at everything, because then you can wind up piling up. And we still are not out of the woods. I mean, here's the thing, going back to that range bound theory. I don't see new highs here happening. I mean, let's not talk about 6 months from now, but for the next 6 months, I don't see new highs. I see potentially a rally back to the sort of the middle of the range, which for where we're at right now, let's use those small caps again. Between 200 and 202 is mid range. We get through 206, maybe we can head back up towards the high of the range. New highs, I just don't see it. Again, unless it's don't fight the Fed and the Fed completely sings a different tune. And we'll see what happens come a couple of weeks when they have their meeting.
All right, Mish, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.